Most people are taught one version of retirement investing, and it sounds like common sense. As you get older, you take less risk. You reduce stock exposure. You add more bonds. You smooth out volatility. The assumption is simple. Aging means fragility, so your portfolio should become more conservative every year. And because this idea has been repeated for decades, it feels almost unquestionable. But here's the truth. There is a growing body of retirement research showing that this traditional approach may actually increase risk at the exact moment retirees can least afford it. And in the right situations, doing the opposite, yes, the exact opposite, produces more durable outcomes. Not because it chases higher returns, not because it's aggressive, but because it protects retirement during the years that matter most. This is where the idea sounds backwards, and that's the point. The biggest danger in retirement isn't volatility spread evenly over time. It's volatility showing up at the wrong time, specifically in the first few years after you stop working. Those early years are uniquely fragile because withdrawals begin at the same moment your portfolio loses its ability to recover naturally through new contributions. A bad market later in retirement is uncomfortable. A bad market early can permanently damage the plan. This strategy exists to solve that exact problem. If you care about retirement planning, take a moment to subscribe and hit the bell. The strategy is often called a reverse glide path or a rising equity glide path. Instead of starting retirement heavily invested in stocks and slowly reducing risk, it does the opposite. You begin retirement with lower equity exposure and higher stability. Then, over time, equity exposure gradually increases. At first glance, that sounds reckless. Why would you increase stock exposure as you get older? Aren't you supposed to be protecting what you have? The key is understanding what kind of risk actually causes retirement failure. Retirement doesn't fail because average returns were too low. It fails because of the order in which returns occur. This is known as sequence of returns risk, when poor market performance shows up early. While withdrawals are happening, losses are locked in permanently. Shares are sold at depressed prices, and even if markets recover later, the portfolio may never catch up. But once retirees make it through those early years, something important changes. The portfolio becomes more resilient. The odds of long-term success rise sharply. The same level of volatility that would have been devastating early on becomes far less dangerous later. This is the insight behind the reverse glide path. Instead of exposing retirees to high volatility when their plan is most fragile, risk is reduced early. Stability is prioritized. Then, as time passes and the portfolio proves its durability, growth becomes more important. Risk is introduced gradually when the portfolio is better equipped to handle it. In plain terms, risk is lowest when losses hurt the most and higher when losses matter less. Let's make this concrete. Imagine a retiree starting with a portfolio of $500,000. Under a traditional approach, they might enter retirement with 60% stocks and 40% bonds or something similar. Under a reverse glide path, they might start closer to 40% stocks and 60% stable assets. The goal at this stage is not maximizing upside. It's minimizing damage. Income stability matters more than growth in these early years. From there, equity exposure increases slowly and deliberately, not based on market conditions, not in response to headlines, but according to a pre-committed, rules-based plan. Maybe stocks increase by 2 percentage points per year. Over time, the portfolio shifts. After 5 years, it might be evenly balanced. After 10 or 15 years, it could reach a long-term target of 60 or 70% equities. What's critical here is discipline. This is not market timing, it's risk timing. And the research behind this approach is surprisingly strong. Studies by Wade Pfau and Michael Kitces show that rising equity glide paths can reduce both the probability and severity of retirement failure in many scenarios, especially when withdrawals are fixed and inflation adjusted. Here's the elegant part. If markets perform well early in retirement, the retiree was likely going to be fine anyway. The reduced equity exposure doesn't meaningfully hurt the outcome. But if markets perform poorly early, the strategy provides protection when it's needed most. In effect, it creates a heads you win, tails you don't lose outcome. This isn't about being aggressive. It's about being defensive at the right time. There's also a behavioral component that rarely gets enough attention. Early retirement is often the most emotionally stressful period. Retirees are adjusting to living off their portfolio for the first time. A major market decline during this phase can trigger panic selling, even among disciplined investors. Lower volatility early on reduces anxiety. It makes it easier to stick with the plan. And once retirees gain confidence that their strategy works, once they've lived through volatility and seen recovery, they're often more comfortable tolerating risk later. This psychological stability is part of the strategy's strength. Now, this approach is not universal. It tends to work best for retirees whose biggest risk is a bad start. People with long retirement horizons, those heavily reliant on portfolio withdrawals, early retirees, and individuals without large guaranteed income streams, like pensions covering most expenses. On the other hand, for retirees with substantial guaranteed income, very short time horizons, or spending needs far below portfolio capacity, sequence risk matters less. In those cases, a reverse glide path may offer limited benefit. It's also important to understand what the research does and does not assume. Most studies evaluate fixed withdrawal rates, often around 4%, adjusted for inflation. They isolate portfolio allocation to understand its effect on survivability. Introducing higher spending or untested assumptions changes the risk profile. This strategy doesn't make retirement bulletproof. It's one lever among many, and it's often misunderstood. Increasing equity exposure later in life feels emotionally uncomfortable, even when the math supports it. That discomfort is the biggest reason this approach isn't widely adopted. The barrier isn't logic, it's psychology. But when used intentionally, in the right circumstances, this backward strategy does something powerful. It aligns risk with resilience. It defends the years when retirement is most fragile and allows growth when the plan is strongest. That's the point. If this gave you a new way to think about retirement risk, take a second to like the video. It helps this content reach people who need it. And if you want more evidence-based retirement strategies that challenge conventional wisdom, subscribe and hit the bell. New videos every week. I'd love to hear your thoughts. Does this strategy surprise you? Would it make you uncomfortable or does it make sense? Drop a comment below.